Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by Latin Excellence. Visit latinexcellence.com. That's Latinx, CELLENCE.com or latinxmovement.com to learn more and shop our merchandise. You are excellence. Hello and welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. Today I want to speak to you about a recent press release on August 30th, 2022 by Bank of America stating that they're bringing out a program for people that want to buy homes with no money down, no closing costs, no PMI, and no credit score requirement. And I know that sounds too good to be true. And some people are actually concerned about this because it reminds them of the financial crisis of 2008. But I want to break down the guidelines as far as we know so far for this program, and also why it's actually different than 2008. Although people do have validity as to why they would be concerned. So let's talk about the program itself. It's called the Community Affordable Loan Solution. And it was just stated recently in a press release. As of the recording of this podcast, there is no information on the Bank of America website as far as the guidelines to qualify specifically for this loan. So I'm going to give you a general overview just based on the press release that they put out. First thing is that this is for first-time home buyers. Now, they did not define what first-time home buyer means in this context. Now, some people might think, well, first-time home buyer is somebody who's buying a house for the first time, but not necessarily. When you look at traditional lending guidelines currently, first-time home buyers are typically described as people who have not owned a primary residence in the past 3 years. So if this program falls under that particular definition of first-time home buyer, it very likely could include people who have already owned homes before, but we don't know that yet. But let's stay tuned for that. Also, it has a zero down payment on the mortgage, which means that you are able to finance 100% of the cost of the home. So sometimes you see these programs listed as 0% down, no money down, or 100% financing. They all mean the same. So what does that mean? Let's say you're buying a house that's $500,000. That means that the bank will actually lend you the full $500,000, obviously provided you qualify, in order to finance this home with 0% out of pocket, hence 100% financing. Now, a lot of these programs are usually geared towards primary residences as well. Normally, these programs are not eligible for investment properties. It doesn't specifically address that in the press release, but based on the fact that they're saying first-time home buyers, I'm inclined to think that this is probably more for people who are buying the home as a primary residence, especially because they have a very community focus to it. So something else to keep in mind as we stay tuned for the guidelines. So let's go back to that example. Say you're buying a $500,000 house. Traditionally, a person has to put down a down payment and then also have to pay closing costs on top of that. There are certain expenses that you need to pay, typically out of pocket, in order to secure the financing. You have to pay title insurance and appraisal and several other things that typically add to your initial cost separately from the down payment. So this program states that there will be also assistance as far as down payment. It actually says, no down payment and also assistance towards closing costs. So it sounds like this program is actually leaning towards letting you get into the house with no money down and no out-of-pocket expenses for closing costs, which is amazing, right? Because a lot of the barriers that a lot of people have before they get into a home is the fact that they haven't been able to put together enough money for down payment and closing costs. Now, another thing to keep in mind is that this loan is also going to have zero PMI, which stands for private mortgage insurance. For those of you that are not familiar with it, typically when you have a home that you're buying and you put less than 20% down, you also have to pay what's called PMI or private mortgage insurance. On FHA loans, it's actually called MIP, mortgage insurance premium, but basically the same concept. The bank needs to be assured that you're going to pay this mortgage back as much as they can. So typically when a person puts less than 20% down, the loan will also have an additional expense in addition to your principal and interest, your property taxes, your homeowner's insurance. There's that additional expense of private mortgage insurance, which obviously adds to your monthly mortgage payment. Now, this loan, based on the press release, it says it will also not have any mortgage insurance. Now, in the past, when I've seen programs that offer no mortgage insurance, typically that means that the interest rate is going to be somewhat higher than the rates that are out of the market because the lender's kind of compensating for the additional risk. It doesn't address this in the press release either. So we have to stay tuned to kind of see what kind of rates they will offer on this program as well. Now, another key thing of this program is that they stated that there's no minimum credit score, which is pretty interesting. A lot of the times when you go shopping for a home and you speak to a lender, you might see there are some requirements that say, okay, you need a 640 credit score or 650 or 670 or 700 plus and so on to qualify for a specific loan or a specific rate. Now, this program is saying that there'll be no minimum credit score requirement. And what that means is that they're going to be looking at alternative methods of credit in order to help qualify the borrower. And those would be things like insurance, like auto insurance. They're going to look at things like utilities. They're going to look at rent. It's going to be a big factor. Now, they haven't said how many months they plan on going back. But based on my experience, when I used to do mortgages, typically banks would want a minimum of 12 months of something when they're verifying. And I remember when they verified rent, they wanted 12 months of rent. If it was a self-employed borrower, they wanted 12 months of bank statements and so on. So very likely, I would say it's probably going to be somewhere in that ballpark where they would want to see if you've been making your rent payments, your auto insurance, utilities, your phone, and so on for, I would imagine, at least 12 months. But again, they haven't been clear on that yet in terms of the guidelines. So something to keep in mind. Now, this program, although it is a community affordable loan solution that is geared towards Black and Hispanic communities, it is not only for Blacks and Hispanics, but it is going to be in those communities primarily. But the actual qualification is income and location. So it doesn't mean that you need to be a Black and Hispanic background in order to qualify. You just have to purchase a home in one of those communities. So that's a key differentiator as well, because a lot of people can qualify just based on that criteria. Now, they haven't stated what the income requirement would be. So I want to tell you a little bit about debt to income ratio and what that means, right? And before I get into that, so far, this particular program, although they have other programs that are in more expanded, this particular program right now is going to be in Charlotte, Dallas, Detroit, Los Angeles, and Miami, just on those 5 cities. My assumption is that these are probably going to be some sort of initial cities, and maybe they'll expand this. It's probably a pilot program. Again, they don't say that in the press release, but I would imagine that this is something that at some point, maybe they'll look into expanding. So let's talk about debt to income ratio. Debt to income ratio is one of the ways that lenders look at the borrowers that apply for loans in order to qualify and see if they could afford this loan. So to keep the numbers simple, let's say somebody makes $10,000 a month or a couple, and the debt to income ratio requirement for a mortgage is 45%. That means that your total loan, including your mortgage, right, principal and interest, property taxes, homeowners insurance, PMI if eligible, and any other debt that you have outstanding that shows up on your credit report, that the minimum payment, that could be a car payment, credit cards, student loans, personal loans, and so on. The combined total of all those cannot exceed that figure. So if a loan has 45% debt to income ratio maximum, and somebody makes $10,000, that means that $4,500 is their top number that they cannot exceed. So to give you an example under that, let's say that your new monthly mortgage payment is going to be $3,500 a month. That means that you have $1,000 leeway to work with in terms of the minimum payments for your car, your credit cards, and so on. So I've seen scenarios where somebody does not qualify for a mortgage because the combined total of their new mortgage and the debt exceeds the debt to income ratio. Now, sometimes some lenders go above the debt to income ratio requirements. If your credit is strong, you probably have to compensate in other areas, whether it's a bigger down payment, stronger credit, and so on, right? Sometimes it might require a co-signer, or the lender might just say, hey, listen, right now your debt to income ratio is 47%. So you're very close. All you need to do is pay off this credit card or pay off this loan or something to that extent. So I've seen that scenario as well, which is why it's very important to sit down with your financial planner before you even go trying to buy a house. Make sure that it's something that actually fits within your budget. I also recommend sitting down with a loan officer before you go looking at homes to make sure that you actually get a pre-approval, where you basically sit down with a loan officer at a bank or a broker or a banker, and they run your credit, they look at your income, they look at your monies that you have available, all of your debt and so on, and determine what is the maximum that you can qualify for. This way, you already know what your maximum is. Then you can go ahead and start looking at homes, contacting realtors and so on. So that way you don't fall in love with a home that you can't afford, right? Now, another thing to keep in mind is that a lot of the time, because the lender is using your gross income where they're qualifying you, I've seen people where they qualify for more than they can afford. And I know that sounds kind of crazy, but it is possible, because if you're making, in my example before, $10,000 a month, they're looking at your gross income, right? So if they say your debt to income ratio is 45% max and it's 4,500 a month, they're talking about gross income before taxes and all that. So it's possible that on paper, you can qualify for things that you can't afford, a mortgage in this case, because there's a lot of things that you have to pay out in your daily lives that don't necessarily show up on your credit report. Remember, the debt to income ratio only looks at typically things that show up on your credit report. This particular program, they're looking at alternative methods. So they will be looking at things that normally do not show up on your credit report. They mentioned utilities, rents, and insurance. Now, they did not mention things like childcare, for example, right? So you might have a very high childcare amount plus your new mortgage. You might not be able to afford a house that you actually qualify for, which is another reason why you want to make sure that you sit down with a financial planner and go through your numbers to ensure that you are able to not only qualify for this home, but be able to afford this home and not become a foreclosure statistic or having to sell the house down the line, right? So those are the major key points there. Now, why is this different than 2008? Because I've seen some people that were concerned about this. And, I get it, right? When I first see no money down, no closing costs, no PMI, no credit requirement, like, wait a minute, this sounds too good to be true, or this is a recipe for disaster, right? And it can be if you don't do it responsibly. But let me tell you why this is different based on what I've seen so far in that press release. Number one is that they're going to verify income, which is logical. But believe it or not, in 2008 and before, when the crisis happened, there were loans where they did not verify income. So I remember I was actually doing mortgages at the time. I was running a branch, and there were loans that you can do. They were called stated income. One of them was you can say, hey, here's how much I make, but there was no proof behind it. Like, they did not ask you for tax returns, pay stubs, or anything. It sounds kind of crazy, right? But that was actually a thing. There were stated income loans where you just stated your income and didn't verify it. There were no income loans where you didn't even put down the amount of money you made. They just didn't even look at that part of the equation. If you had a certain amount of credit score or whatever, they're like, hey, don't worry about your income. We got you, right? And then there were no doc loans where it was crazy. Like, your application pretty much had your name, address, social security number, date of birth, and the property you're trying to buy and the purchase price, right? A very minimal information. There was like no documentation at all, no income, no assets of any kind, right? And that all sounds crazy, but that was one of the major factors that contributed to the 2008 subprime loan crisis, because a lot of people were incentivized to just buy homes that they couldn't even afford. And the bank had no way of knowing that they couldn't even qualify for these, because they chose to offer these loans that specifically did not require for any type of documentation as far as your income or your assets, right? So that was a recipe for disaster. So unfortunately, yes, a lot of people got into loans that they shouldn't have gotten to. Values were overinflated. It was a perfect storm of factors that ended up hundreds of banks going out of business, millions of people foreclosing, people doing short sales where they were basically selling the house for less than they owed on the balance of their homes. It was complete disaster for a lot of people, right? So when I see these guidelines, obviously I understand why some people would be concerned, but there's still a responsible way of taking advantage of this. Now, that being said, just because you can do something doesn't mean that you should, right? So this seems to me like a great opportunity for some people, especially in those areas that are available. Maybe you were priced out of the market recently because the market prices, as you've seen in the past year, have been outrageous, right? There were bidding wars and so on. Rates were pretty low. Now rates did go up and prices are starting to come back down, right? Now, maybe they'll continue to come back down. So you may not necessarily have to jump on this immediately, but I feel like it does not hurt to get familiarized with the program guidelines. So at least you can have that in your back pocket, right? Again, it's no down payment, right? Now, maybe you have some money that you've saved up for a down payment. You may still be able to take advantage of this program. I don't know yet because I haven't seen the guidelines because they have not been released as of the recording of this podcast. But I've seen other programs like FHA loans where the minimum down payment is 3.5%, but nobody's stopping you from putting more down, right? So you can still get an FHA loan and put 5% down or 10% down, right? So this program may offer that, right? You never know. You might be able to get into a home with 10% down, no PMI, and some closing cost assistance, right? That would be amazing. So for those people that were thinking immediately back to 2008, I understand that, but I feel like there is a way to do this responsibly. And if you follow steps like sitting down with a loan officer, making sure you're pre-approved, sitting down with your financial planner, make sure you can in fact afford this home, not just qualify for it, this might be a great tool for you to finally be able to buy the home that you've been looking to buy and just take advantage of this opportunity. You know, some people choose to not put money down if they have the opportunity because maybe they don't want to wipe their savings out, which would not be a good idea because things go wrong in homes sometimes, right? You might need to do some repairs down the line and you may not want to just wipe out your emergency savings. So even if you had $20,000, $30,000 in the bank, you might still choose not to put any money down if you can, because you can keep the money as a cushion for emergency savings and maybe investing down the line, right? So it doesn't hurt to get informed, learn more about this program, and discuss with your financial planner and your loan officer to see if it's right for you. So those are my 2 cents on the program. As always, thank you for tuning in. Any questions, send me an email, luis@onmywaytowealth.com. And I'll see you in the next episode. Stay tuned for the Grown Up Latino, Growing Up Latina series. Hispanic Heritage Month, it is upon us from September 15th to October 15th. So I have a great lineup of guests that are just going to be amazing, sharing their stories. And I just can't wait to share them with you. So thank you again. I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.